right, we're back with another live replay of our webinar from May 2025. We had a solid turnout. We had some good questions and actually some good interaction from everybody this episode. So we really love that. When we're going to start doing that more often. They throw these questions out that we get to the group and see how the group answers, because a lot of these people, a lot of the attendees here are practicing and have been practicing the infinite banking concept. So what we talk about during this hour-long webinar, Paul?
Yeah, we talked a little bit or a lot about college tuition. And that was kind of an example that we talked about of, okay, I've paid for my children's tuition, $200,000 or whatever it was, whatever you had saved up. And now I've got these policy loans out, and now I have this premium to pay, and I've got these policy loans to pay. What do I do? And we kind of go into, your options of what you can and should do to address that. Really, it's great. You've got a place to put more money, right? And that's kind of what we talk about in that in that webinar.
Yeah, we also hit on juvenile policies and even getting policies on other insurable interests. If you can't get one yourself, or if you want to get one on another family member, we cover some of that too. So hope you guys enjoy, and we look forward to seeing you on the next webinar in June. Hey, I'm Dave.
And I'm Paul.
And this is the Wealth Warehouse Podcast.
The questions come up lately about juvenile policies. And Dave and I have covered this in the podcast over the years, but I wanted to just hit on it again. So after we get mom and dad insured, assuming they're insurable and they're paying the premium they're going to pay, and the intent is to open up policies on the children, that's great. And that's what ought to be done. But I think there's this misconception out there, misunderstanding that a child's policy is going to look better or be more efficient from an IBC perspective in the near term. So they want to pay more premium, like, I want to pay more premium on the child. And they understand the constraint of the death benefit. Like generally it's half of what the least insured parent has. So if your least insured parent has $1 million death benefit, the child could have $500,000 at most. But it's better if there's additional premium dollars, we shouldn't hold those back from mom and dad's policy expansion. Like if there's additional money eventually, we should definitely get the kids started. But the children's policies should be relatively small compared to the premium we're paying on mom and dad's, and they're going to be. So
there goes the dog. Paul's got to yell.
There goes the dog. It's just, I can't wait to move, guys. I'm sorry. This setup is, I'm at the dining room table now, and but anyway, so if there's additional, let's get the kids started. We'll add the special rider, the OPI, the option to purchase additional insurance rider on the child's policy. The waiver of premium rider will be on there as well. And we'll start paying premium on the kids, right? But future system expansion, if able, should happen on the parents, because the parents are actuarially going to graduate from this earth sooner, right? And I know that's very obvious, but it bears repeating because we keep running into these things, and it's okay. It's okay to want to do right by the kids and all that stuff, but we're going to do right by them by paying more premium on ourselves. Does that make sense? Anyone wants to chime in with comments, please do.
Yeah, I'd second that. Of course, you want to max out mom and dad, max out the breadwinner, max out the other spouse, then the kids. I started my kids, two of them, the two that were born are already alive in 2010. I started their policies 15 years ago now. And it was like $2,300 a year on those things. Now, those things are on fire, and there's a lot of cash value in there. And I don't ever use them because I just figured kid policies, I'm just kind of putting that money away, and I'll figure out what to do with it for them when the time comes, whether it's for college or gifting it or paying for a wedding or whatever it may be. But those aren't the ones I'm really going after and utilizing to finance the things of life. I'm using my bigger policies, the ones that I'm really maxing out for myself. now that you bring it up, I mean, it may be time to go back and get another policy on the kids, but I guess with all my kids, it would have to be like seven more policies. I don't know if I'm ready to do that
Yeah.
all at once.
Yeah, I'll be honest with you guys too. I use my the cash value that's in my children's policies. They were opened, they're pre 7702 change policies, so they have the lowest policy loan rate. I use that cash value all the time. So it's remember it's a system of policies, but the best efficiency is going to occur when you have policies on mom and dad. They're also more efficient than juvenile policies. Juveniles get some sort of rating. It's a juvenile rating. It's kind of like, I don't know, adult standard tobacco or something is what mathematically it kind of equates to. And I'm
Yeah.
probably a little bit off on that, but it's less than standard, if that makes sense. And eventually, once they enter adulthood, you can get that changed over. So anyway,
Yeah.
But what happens if dad is 75 years old, has congested heart failure, and is a diabetic? What do you do there?
How young are dad's
so
kids?
yeah.
55 and 60.
Okay, so we're not talking juveniles.
No.
Um, yeah, absolutely. You can get policies on adults. I'm actually working right now with, here's a situation. I've got a client, her and her husband, well, at least the husband's 70. I don't know how old the wife is off the top of my head, but they're probably about the same, right? The husband actually just got a policy at 70 years old. So he's my oldest client so far, but it still works. And he's using another strategy to put that money to work, or he's got money to work in something that's paying him, and he's using that to fund the premium. So pretty cool strategy, and we can talk about that later if you guys want to. But mom now has a policy as well, and her daughter is married, adult, an adult married with children, and her son-in-law does not have life insurance. So mom wants to protect her daughter by getting life insurance on the son-in-law. So a little bit complicated there. So working with the insurance company, I threw him a hypothetical, and it's pretty simple. The daughter can own the policy on her husband, and mom can be the payer. So mom can pay, daughter owns it. Now, that being said, once a policy is issued and you're the owner of a policy, you can change ownership to whomever you want. Daughter could transfer ownership to mom and let mom be the owner and the payer on that, and just keep the daughter as the beneficiary. So there's a lot of flexibility there. So in your case, Amani, am I saying that correctly?
Yes.
Okay, good. In the case of, say, the father you just mentioned, yeah, if he's not insurable, if anybody's not insurable, then yes, that's an exception where you can get a policy on another insurable interest without having insurance yourself. So it doesn't have to stop you from being able to get insurance on somebody else just because you can't get insurance. Does that make sense?
Yes. Thank you.
Mm-hmm.
Yeah, that's a great question. And Nelson Nash has a small portion of the book dedicated to that, where the parents are buying a policy on their daughter, and yeah, it happens. It happens all the time.
Yeah, pretty cool thing to do too. And if you want to get into, I'm not a tax professional. This is not tax advice, of course, but there's the gift tax, which I think right now is like $19,000 per child that a parent can give to their children without it. Tyler can back me up here probably, but without it triggering any kind of tax implications. It just goes against their lifetime.
The lifetime gift tax exemption, or
Right.
whatever.
But they can gift their children enough money to fund a policy that their children own,
What a stupid
or
thing!
or that they own on their grandchildren. It is stupid. The gift tax, like,
Unbelievable.
yeah.
On
No,
a
yeah.
technicality, you can gift more than that in a single year. You just have to fill out a form that says, well, this is going to go against my estate
2020.
tax
Okay.
thing, which is like $13.9 million.
Right. Your total lifetime exemption, right? And that's the same
Correct.
way for like I own the policies on my children, just like Paul does, just like anybody, any parent who has juvenile children, you own the policy on your children. You can gift that policy to them later on in life, and there's zero implications to your children. They get to inherit that policy, all the cash value they have access to, no tax implications whatsoever. The parent, it just counts against your lifetime gift tax limit.
Which, if the person is married, it effectively doubles to 38,000 because you can gift
Both children,
19,000
right?
to the both. Yes,
Yeah.
correct.
I'll bring that up to my in-laws.
I've brought it up a couple times.
Yeah, just drop that over the holiday dinner.
Hey, what's Paul? What's my one time?
Oh wait, you have 38,000 you don't know what to do with? I got an idea. All right. Anything else on juvenile policies? We've seen a big uptick in parents coming back for juvenile policies now after they get their policies and they're like, all right, time to get put something in force for the
So
kids.
I don't have children, but my like if my either my brothers or whatever have children before I do, and I wanted to effectively open up a policy on the child's behalf to act like a 529, what would I encourage my brother and his wife, my brothers and their wives to get policies first, or is that
Yeah,
a no-go?
parents will need insurance before the kids can get insurance.
Okay.
Yeah, so if parents don't have any, one, you need to shame your brother into getting life insurance for his own children and his
At
wife.
least term.
Yeah, get
I mean,
something.
I think they have term, but
Yeah,
I would want to open up a policy like this.
yeah, and you don't need as long as they have life insurance. It doesn't have to be whole life. It can be anything.
Right.
That'll qualify their children to be able to get life insurance.
Oh, okay, gotcha.
Hmm.
Would
So
be
could I
that would
take out? Oh, sorry, who's gone?
I was just going to ask if that would be the same for stepchildren. Like my boyfriend, um, we're not married yet, but that's the plan. He has 3 kids. He does not have life insurance, so he would have to have life insurance first, and then once we are married, then we'd be able to do policies on the kids. Am I understanding that correctly?
Yes.
Yeah,
Okay.
yeah. I mean, I've got policies on all of my stepchildren.
Okay.
Yeah.
Cool. Thanks.
Yep.
And so my brother's got 5 kids, and has no life insurance. Could I open a convertible term policy on my brother?
I think you have to make the case to the underwriter where if something were to happen to your brother and your sister-in-law, would you become the primary caregiver for those children, for example?
Okay. So it probably wouldn't help my case if they live in a different state and all that, like justifying it.
I don't think that
Yeah.
necessarily matters, but I
No,
mean,
that doesn't matter.
if you're the godparent in the sense that
Gotcha.
the kids would be living with you, then maybe that could be a justification to use with the insurance company. We can't tell you what underwriters are going to say, but you would just need to justify it that their death
Gotcha.
would have a financial impact on you.
Gotcha.
Right.
Cool. I'll bring that up to him because I don't think he's going down his research and all that stuff, and he's on board, but he just got a new job and all that stuff. So,
Yeah.
just
Yeah,
trying to.
term is cheap. Go get some from
Yeah, I told
wherever.
my brother and my brothers and sister that if you guys want me to care for your kids, if both of you and your spouse graduate early, you better have some life insurance that's going to me to
Mhm.
take care of them because that's a big expense to be placing on somebody's shoulders,
Yeah.
along with the emotional toll.
Yeah.
Yeah.
Cool.
Not that I would turn my nephews and nieces away because, their parents didn't have life insurance, but I let them know you're going to need some life insurance.
Gotcha.
Yeah. So I had a question come in from a client today who couldn't make the call, but I thought this was a good one. I'd like to just open this up to the group here and get your guys' input on this um, before Paul and I pipe in. And I'll summarize. It's kind of a long email, long question, but it has to do with planning for college, say. So in this example, he says, using the infinite banking concept and whole life insurance instead of a 529, let's say I'm putting away $50,000 a year into a policy right now while my kids are young and I've got 4 kids with the idea that as they go through college, I'll use that cash value to pay for their college. And he's estimating tuition of 50,000 per kid. So a total of $200,000 he'll have to pay. So he asked, so once the kids are in and through college, and I paid that 50,000 for each of them, so now I have an outstanding policy loan of $200,000. I have the ability to continue my $50,000 a year premium payments because that's what I've been doing. But what are my plans for paying down that policy loan? So basically he's saying, hey, now I've got that 50,000 a year premium I'm paying. I've got a $200,000 outstanding loan. How am I going to repay that? Or what do I need to be thinking of right now to have a plan to repay that? Because I don't want to steal the peas. I want to play honest banker and repay the loans I have. So in 20 years, when all the kids are through college, I got 200 grand out in a loan. How am I going to repay that in addition to paying my $50,000 a year premium? Anybody
Well,
here have
he
thoughts?
just had kids go through college, so the next step would be a job, right? Would
For
be
the
my
kids?
thoughts. Yeah.
I
mean,
love where you're going with this.
Yeah, Paul and I had the same thoughts of maybe making the kids pay. You could be the
I
bank,
mean,
but make the
yeah.
kids pay it back.
Yeah, I mean, because if you're it's the family bank, and as long as they understand, like, I'm going to pay for this up front because you have no money, but you should be getting a career. That's why you went to college in the first place. And versus you going and get student loans where they say this is how you have to pay it back and when you have to make these payments and all that stuff, you being there, him being their parent, he could say, hey, if they fall on hard times, maybe don't get the career, change careers, whatever life throws at them, then they can have that conversation with their parent instead of, you know,
Right. Maybe put a halt
and
on the payments at that point and have some more flexibility.
yeah,
But also, so you're basically saying the kids, in your mind, the kids would have skin in the game and they're paying
yeah,
that back, even though
yeah,
it's just better because they're going to the family bank instead of the federal government for a
right,
handout. Okay,
right.
cool.
Yeah, I like that answer. And I think if the work has been done, if the generational work on education, college age student, a high school student can read Nelson's book, right? There's 12-year-old children reading it and 14-year-olds presenting at the think tank now. Like, so it can be understood. And I think, what I explain to my kids is, this cash flow that you're providing me to help repay your student loans will benefit you, and here's how. As long as that is understood, that becomes family banking, and that's what we're trying to do here. This shouldn't stop with us, folks, right? We shouldn't just, yep, we did this, and you guys get to benefit, and then it dies like the Vanderbilts. This should be something that is taught and lived generation after generation. So, Dave Waller, love that answer.
I could add on to it. Yeah, very good answer. I would add that the parents should be having good groundwork of conversations with their children about what profession and what studies you want to go into, and so in setting up a system that your children are going to be paying the family bank back, ensuring that they're finding work and finding studies and majors that are going to be lucrative and that are going to have a fighting chance, to be able to sustain, good payments back to the family bank.
Yeah, kind of like page 75 of Nelson's book, A Different Look at the Monetary Value of a College Degree. No, if you're going to get a college degree, maybe it should be useful so that, I mean, if you're going to loan money when a bank loans money to you, they're loaning on your capability to repay that loan. Do you have the capability to repay that loan? Maybe it should be the same for college degrees. If I'm going to pay for my kids to go through college and they're going to pay me back, I need to make sure that degree they're getting is going to pay me back.
Yeah, there's just a monopoly on that whole student loan thing, right? That's why it doesn't work. That's why you have these people that majored in, I don't know. I majored in history. It's mostly worthless, right? I was going to be an Army officer, so I majored in what I wanted to. But in the actual world, it probably wouldn't have equated to much. I can go teach it to somebody else, right? So yeah, I like that.
And honestly, if the kids are the beneficiaries, then that money's gonna ultimately go back to them anyways.
Right.
Multiple times over.
Multiple times over. So why wouldn't they?
That's right.
Right.
And
so it's basically they're putting away money for their retirement plan, because presumably, if things go as they normally do, they're going to be retired at the time that their parents graduate, and then they're going to receive their inheritance.
Prepare for windfalls. Rule number 6.
So they're actually funding their retirement windfall while they're young by repaying that loan, so that there's more net death benefit to be paid out to them when their parents are gone.
Okay,
All
there's
right.
other
other ways.
too,
So
isn't there?
yeah, what are some other thoughts if somebody's thinking 20 years in the future, how am I going to repay this loan that I have out at that time? If I've only got, if I'm only able at this time to put away 50,000 a year to do this and no more.
Well, shouldn't you be building for your passive income years, or like you should be using your cash value to buy businesses, buy real estate, buy cash flow intensive items so that I don't know if that was said already, but
No.
That's good.
I mean, that's what I'm
assets.
using mine for.
Yeah.
I mean, I used it a little bit to keep up on my rental, and now I have something that pays me money every month, or someone that pays the mortgage and me money every month, and I mean, that's what Pillsong is gonna do, right?
Yeah, you better believe it.
I
So
mean, that's the idea, isn't it? Like,
Yeah.
you don't. I mean, I know you guys talk about a lot about just you can let the cash value, and then it's just your giant emergency fund, and then you have this policy, but can't you deploy that capital and use it for things? I mean, you don't have to be like Paul and buy 17 cars.
Yeah.
There's only
Wouldn't-
6.
I'd like to be like Paul, though.
He says it's only 6, as if that's not a lot of cars.
That's only because his garage, he only has a 6-car garage, so he doesn't want any of them out. Although he's going to have lifts in there, so he can actually fit like 8 cars.
Yeah, it is a problem.
It's a problem.
It's a problem.
Yeah, but to your point,
but-
Tyler, that
Yes,
shouldn't be the only asset you're building.
Right. I think it's going to depend on the individual, right? Some people are like Nelson says in the book, right? If you took all the money in the world and redistributed it to everybody equally, in a few years' time, it's going to be back to where it was. Buffett's going to have a bunch, Bezos is going to have a bunch, Zuckerberg, whoever, and the list goes on, right? So that's good for a lot of people, though. But I think the IBC mindset will get people into that, thinking, oh, wait, I need to be making money while I'm sleeping. Otherwise, I'm going to have to work until I die, which, you don't want to have to. You want freedom of time eventually. And I think that's a great point. That's part of this mindset, I think, is gaining that freedom of time so you can do what you want to do. And it's not like everyone's going to be a real estate mogul and have 100 single-family rentals. They're not. But you could have a few, maybe, right?
Right.
So I think, that's a good point. That's one way. Yes. Make more money than you were 20 years ago. Yes.
Yeah. So what are some of the assumptions in this question? The assumptions that 20 years from now, he'll be in the exact same financial position he's in today.
Right. Which is probably not correct.
Hopefully not.
It's probably not a good assumption, is what I would say. Some other thoughts that we had, Dave, was, he could pay the base premium only on that series of policies, right? And redirect the extra money that he was directing toward PUA toward repaying the loan. You could do that, right?
Yep. That is something you could do.
What else? Anybody?
And he actually even mentioned that,
He did.
some
Yeah,
things
yeah.
he had were, not paying the PUA and funneling that money back towards repaying the loan. He could count on having additional income to direct towards it. So this is true. Like we said, would you, 20 years from now, are you going to have the same income level, and are you going to have the same amount of expenses? Like, what happens when your kids graduate from college? Most people get a massive pay raise.
Yeah, hopefully they're not still like walking into the fridge and eating boxes of
boomerangs.
cereal every day and stuff, right? Yeah. So no, what do they call it? Economic outpatient care, I think, in The Millionaire Next Door. That's what they called it. So hopefully that ends. So that's a windfall.
Yeah. Yep. Fewer mouths to feed.
The water bill goes down. The electric bill goes down, especially when you have girls, right, Dave?
I don't even look at it. It's auto draft, so I don't have to see it.
And if he plans on paying off his house, then that will be gone.
Right?
Yeah.
No house payment.
Yeah.
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 So I think we answered that question pretty well. Gave him some things to think about. But I really like, the skin in the game thing. I think that's how it ought to be, right? Our parents raise us and whatever we can. I don't feel obliged to pay my children's college tuition at $100,000 a year. That's a lot of money.
Yeah. No, I don't either. And, here's one thing I definitely agree with Dave Ramsey on is he says, if you're going to go to college, pay cash, like pay your way through college. Don't take a loan. Don't go into debt to go to college. I mean, I can't imagine how much you would appreciate your college degree if you actually worked your way through it and paid as you went. If it takes you 6 years, so what? Who said it's supposed to take 4?
Yeah.
Like, where did that come from?
Yeah, that's the way it used to be.
Yeah. On that note, though, I'll just throw this out there. If anybody has $40,000 or more in federal student loan debt, send me an email. I might have a plan for you to free up some cash flow.
What if you're close to that?
If you're close to that, sure. But
Like
if you could free up
30,000?
Yeah, 30,000 maybe, but it's really kind of like the sweet spot is 40,000 or more. But we could talk about 30,000. There may be
There you go, Tyler.
some things available that could free up some cash flow to funnel towards more, permanent wealth.
Just go incur some more student loan debt.
Yeah, go get 10 grand more. Go back for another degree you're not going to use.
I use my degree every day.
You do. I know, because you're a professional. Yeah. I don't use my degree.
Every day.
Right.
All right. Anything else on that topic comes to mind? So Tyler, you brought up using cash value to build cash flow elsewhere. And we were going to bring up, I don't think we're ready for a calculator or anything, but I'm happy to share what I've started doing last November, December. And Paul, are you involved in that too? Are you getting in on that?
I am. Yeah.
Okay. So those of you who are, those of you who know, but there's something that I've started participating in where I'm taking cash value loans, putting them to work in creating a note that is then giving me amortized payments back every month. And that's actually going back to the guy I mentioned earlier, the 70-year-old who just got a policy. He's funding it monthly. what he did, he had a chunk of cash he wanted to put to work, but he wanted to put it to work in the most efficient way possible. So he's a member of this other group I'm a member of, and there's a program there. And he decided, well, I'm going to take this money, I'm going to put it into this program to create a note that's going to turn into monthly amortized payments coming back to me for the next 5 years until that note is completely repaid. So that amortized payment is principal and interest every month coming back to him. What we did was took that monthly payment and created a policy monthly premium out of it. So that exact number that's coming back to him every month, a few days later, the company drafts that amount out of his account and puts it towards policy premium on him. And I'm actually doing the same. So I decided to take a loan against my cash value to participate in this. And instead of using that money coming back to me to repay that loan, which I could do, I just plan to repay that loan through normal cash flow. Whenever it gets repaid, it gets repaid. So whenever I have extra money, I'm throwing it against that loan to repay it myself. In the meantime, I'm taking that amortized payment coming back to me every month, and I created a new policy using that as monthly premium. So I'm using my cash value loans to create an upside for me that increases my ability to fund another premium. Go.
Question. Did you set that up as are you paying that premium annually? Like, did you front money for that premium somewhere else, or did you started a monthly premium with that amortized?
I just did monthly. I got my first payment in January, and I have a convertible term, so I could quickly create a new whole life policy very quickly, so that like 3 days after that payment hits, because it hits on the same day every month, I have the company draft that exact same payment out and go fund a monthly premium.
Awesome. Cool.
Yeah, that's what I did.
I like it.
So it's hands off now.
Yeah.
I don't even think about it. And it guarantees it's going to get funded for the next 5 years without me thinking about it. All I'm responsible for is repaying my loan, which again, I'm just doing that out of excess cash flow that's remaining at the end of really after the first week of the month. All my bills are due like in the first week. So after that, anything that comes in, I'm throwing it back towards that loan.
I like it. And of course, folks, that would work with any cash flowing thing, whether it's some sort of note that you set up, or it's a rental property that you have, like Tyler there, or whatever. Maybe you have a business or a side hustle, whatever you're doing, moonlighting. You have people that moonlight as doctors and physician's assistants to make extra money. Could be any of those things, right? So I like it. That's good.
Yep. Now you were talking to somebody recently, actually somebody we're working with, who you said he makes a base salary and then he makes bonuses.
Yeah. So he's got a base salary, which is kind of we've got several people like that in the medical field that have kind of like their base salary and that's what they can reasonably expect to get guaranteed every single year because their hours are pretty static, right? So, the mindset of, all right, I'm gonna live off that and pay my mortgage and pay my car payments off that, but I'm gonna use all this extra income. And I take the average of the last 2 years of what they've made, let's say, and they're like, I think I can reasonably, Paul, make this easily. And we kind of design a series of policies for their family off that income. So that's another way to do that. If in the profession, we have a base salary and then bonus. We have medical professionals that get, in the military, they'll get maybe a $60,000 bonus if they're a doctor or if they're a nurse anesthetist or something like that. And they use that entire bonus as premium. And that they can live off the rest, right? They're capitalizing this, which is a great amount of money. It's a good portion of their salary as well, total. And it's a great way for them to think about it. Like, I'm just going to park that over there, not even touch it. Because otherwise it would get spent, right? It's going to get spent, going out the door. Parkinson's law.
Yeah. That, on the note of premium, I was working with somebody just recently and had another conversation with them today actually about their policy premium. Right, we're getting ready to put it in force. So we're looking at their income and what they live off of, what they put away in savings. Let's say savings was 15%. Let's say the income for round numbers was $100,000. They put away 15,000 a year in savings. Well, there you go. Perfect. That's 15,000 a premium. But when digging in further, where else are you saving money for maybe a big expense once a year or twice a year? And we looked at, well, there's charitable giving. I put away 10% there, so there's another 10,000. I'm self-employed, so I put away a good 25% for taxes. So there's 25,000. I pay my children's, say, their school tuition once a year. They go to private school. So there's another 10,000. These numbers start adding up and I'm like, well, look at all that money. And they escrow. You can escrow your mortgage and taxes, your taxes and insurance, that is, with your mortgage company, right? You escrow it yourself instead of letting them do it. So there's another, say, $2,000 every 6 months that he can capture. Well, you start adding all those numbers up, that's a big number. Now, did we use all of it? No, but we used more than 15, which was a savings rate. Because we're also going to put some of that other stuff that's just sitting in an account for mostly a full year or at least 6 full months before it's being used. And we're going to capture some of that as extra premium. So it's still going to be there, available to borrow against. And then what do they do if they had to borrow $2,000 to pay their escrow, their taxes and insurance? Well, in the next 6 months, they were going to save up $2,000 anyway. That $2,000 now just goes to repaying that, refilling that, so it's available again to take out 2 months later or 6 months later.
Yeah, holes in the bucket, man. Gonna plug them.
So many holes in the bucket.
Gaping. Yeah. I've got a client that's about to do that with his quarterly taxes. He's a good boy, and he pays his quarterly taxes. He doesn't file an extension or whatever. He does the right thing, and he socks that money away. But it's as he gains, and he'll know I'm talking about him. But as he gains, taking over the family business, and he's I think the 80% owner now, but a couple of years it'd be 100%. But his share of the tax bill now is 60 to 80 grand a year. That's a big gaping hole. You think about sending that to the IRS every quarter. You're sending 15 grand, 20 grand to the IRS every quarter, and that's gone forever. So we're in the process of designing up, doing some convertible. He's got convertible term. We're going to convert some of it and kind of do a little tax strategy so that those holes get plugged, at least partially.
Yeah, and it's not like maybe he can't capture all of it, but what if you could capture 10%, 20%, 50% of it in a policy? That's going to build something pretty massive over time.
Yeah, that's right. Yeah, it's better than capturing none of it, that's for sure.
Yeah. Yep. So I think there's always ways to find more premium if you really want to. Like most people, if they really want to buy something and they don't want to put it on credit, they're going to find a way to find the money to buy that. Right? You could do the same thing with your premium.
Do we want to bring up the guy from TikTok with the dog picture? Like Waller's laughing.
Yeah. Well, sure. That
it was a 529 thing, right?
Yeah.
It was that a go ahead, David. What was that? It was
yeah, he's just really convinced that a 529 was better than whole life insurance because once again he kept going back to the returns that he would get, a percentage of returns that he would earn on the money, totally not taking into account that is used for primarily one thing.
Sure.
And when I brought that up, he was kind of like, oh, well, you could also do this other thing with it if you had to. I was like, okay, well, that still doesn't make any sense when I can just do anything with the cash value. So I don't have to ask and say, hey, it's under this circumstance that I need to access the 529 money. And they're not taking into account the returns on anything else that we do with our cash value. It was just within that vehicle that he was focused on, which is, every IBC hater's problem is they're focused on the returns of what they're getting inside one vehicle or another, but they have no idea what each individual person could be doing with their cash value, investing in real estate or doing, whatever deals they're making, private money lending, and so on and so forth. He was pigeonholed on one thing.
It's almost like Nelson knew what he was talking about when he wrote on the very first page of the book. I mean, it's page 3, but it's the very first narrative page, the introduction, that this book is not about investments of any kind. It is not about rates of return. So it's tough to argue with people like that because they can't get over the fact that it's, they can't get out of their own way when it comes to rates of return. But
David was pressuring us to have a debate with this guy, and he sends me the picture, and it's, a shirtless man holding what looked like an 80-pound dog probably. And I was like, come on, like, I'm not going to talk to that guy. But you're right. They're everyone, I think that a lot of people mean well, but they're arguing from a position of complete ignorance, right? Even those the guys that appear on YouTube that I kind of talk about once in a while, they appear to be very nice gentlemen, like guys I would probably have a beer with, but they're certified financial planners, yet they know nothing about whole life insurance. They really know nothing, and they had to go seek out an expert from wherever, who's not an expert, right?
Yeah.
And trust me, having been in the business a while and talking to different people, whether at their home office or some other companies or whatever, the mindset of how to use this is really isolated to the IBC community. Like, people are not thinking like you guys are. They're just not. Those thoughts on how to use whole life strategically doesn't exist really outside this space. It really doesn't.
You know what? Has anybody listened to the Nelson Nash Institute podcast that was started just this last year, called the Infinite Banking Initiative? So yeah, I've been listening to that. That's a really good one. I listened to one of the recent episodes with a guy who was in the business for like 24 years before he met Nelson. And he met Nelson, and Nelson just took him to the woodshed about banking and how money really works. This guy had no clue. He thought he was doing well in the business, 24 years as a financial professional, and didn't understand the basics of banking. So this, if that guy didn't understand it, how much do I'd say most people not understand just the basics of banking and how money really works in this world. So you can't get too educated on it.
Yeah, and a lot of people's comments, they 80% of them like, oh, well, you're biased because you're selling life insurance. Well, they're biased. We could just say the same thing to any financial planner. They want, assets under management, and they want those people confused about what to do with their money because they know all these plans in their head. And they'll say things like, life insurance is so confusing. What are you talking about taking a loan and doing this or that? But then they go on to explain all the different plans under the sun that all have different numbers to memorize and what their use cases are for. And, oh, you can use it for this if you do that. So they say IBC is confusing for the general population, but then they start to spout out like dozens of different strategies on what they can do with this individual plan is for this, and this individual plan is for that. And this one will get you this rate of return, and that'll do that, but there's only one pool of capital. So why are you sending all your money out to these different plans, and then you have to go to your financial advisor to say, what does this one do again? Versus just saying, send money here now, and I'm going to use it for this.
Yeah, it's all about the way you think. You're spot on.
Yeah, I like simplicity.
Super simple. That's what they don't want. They don't want it simple because then no one's coming to them.
I think on our recording the other day, Dave, we were talking about how at the gym where I used to work out at the office in Arlington, Bloomberg is playing, right? It's on there at all hours of the day, and
Yeah.
you can go on the news, listen to the radio, and they're talking about the Dow or the S&P or the Nasdaq, and there's always a report during that little 5-minute news blip on what the market's doing, and people are glued to the television looking at it. And people are arguing about it on social media, and it's just like. Some of you are probably really savvy stock market people. I never was. I just dollar cost averaged and did okay that way. But I'm not a strategic picker or any. In fact, I don't do any of that now. But it's just what an annoying way to live, though. I think just especially as you age and you want to just be in passive income time and relaxing and having your grandchildren sitting by the pool having a cigar or whatever you're going to do. But you got to worry about what your retirement account's doing. I don't know. I think have that stuff, but my gosh, have something that is a hedge against a bad market.
Yeah. I was actually texting with a client yesterday, and he noted, hey, interest or loan rates have gone up. Like my policy anniversary just hit, and now it's higher than what it was for the last year. Because insurance companies have raised their loan rates because they need to. They need to stay, for a healthy portfolio and a healthy portfolio of a company that we own, that I own. I'm fine with that. But he couldn't really get past the fact that he said, it's not really a good vehicle to borrow against now, to borrow from. And this guy is very savvy in the stock market, and he uses margin loans. So do you guys know what margin loans are? So basically you have stock, you collateralize a stock for a loan from the bank. Presumably use that money to go put it into other stocks and hope that nothing changes and everything ends up well. And the market doesn't drop or anything, and they call your loan. They do a margin call and call your loan due. And then you have to sell for a loss and you're underwater. But he's like, well, I can get 5.5% over here. Why would I do 7%? So I don't know. I think that's a good thing for everybody to think about. Like, what are the benefits of using your cash value loan? Even if the rate is higher than maybe you could get somewhere else on other terms.
Well, if you own the grocery store and the prices of the goods in the grocery store you own just went up, you would still go and shop at your own grocery store, right? Because it doesn't matter that the price of produce went up when you buy it. It's still going into your system, right?
I'm still going to shop at my store.
That's a really good analogy. Yeah, even if your store was slightly more expensive, it's your store. I'd absolutely go shop at my store than go across the street to somebody who's slightly less.
Yeah, it's about banking. Interest rates are up, interest rates are down. The business of banking goes on. So, in the end, more power to him. The banker can do whatever he wants. If that is better for his situation, that's great. But it's all great until it isn't, right?
Yeah.
At least with, I'm an owner of this company or these companies, right? These mutual companies. I own it. So the loan rate to me, and I think we've unpacked this before, Dave, but it's, protects the dividend. If if they raise a dividend 40 basis points in a given year, but they had, they're keeping the policy loan rate up a little bit because they have to, because it has to conform with their overall portfolio, right? You don't want policy loans to be a drag on the overall portfolio, because some of these companies, right? Some of these mutual companies, the policy loans are 18% of their overall portfolio. 18 to 20% on some of them, right? Some are a little bit less, 12%, but they're a significant portion of the portfolio. So we can't have policy loans being a drag, especially if there are people out there stealing the peas And that's a real drag.
Yeah.
So
Tyler says, hasn't anyone dealt with banks? It's terrible. That's funny because I just got an email this morning, or maybe it was late last night, from a client who says, "Hey, I just took a $50,000 loan to pay off my car. I'm working with a bank on a mortgage for a new house. Well, they saw that my bank account showed an influx of $50,000, and now they want to know where it came from. What do I need to show them? You know, because the banks, they're going to look at your bank records today. They're going to look at them 30 days later, right before you close. They want another copy of them to see if, oh, is any money coming in that we don't know where it's coming from? They're watching you like a hawk. That's not fun.
Mine was $2,500.
You're what?
$2,500 was
They
put into my bank account by my parents.
and they
And
questioned it,
oh, they questioned it. I
and they
wasn't
wanted a
allowed to
letter.
use it.
Probably they probably wanted a letter
Yep,
from
a
your
letter
parents saying
saying,
this is a gift.
yep, it was a
Yep.
gift. I wasn't allowed to use it. I wasn't like,
Yeah.
I think all of this is a result, and I don't know if I'm right, but I think this all changed under Dodd-Frank, like 2011, 2012. Because I remember buying my first house. It was like income verification, maybe a checking account statement. I don't really remember. This was 2006, but it was very easy. Credit pull, hey, credit's over 740. We don't care after that. What it
Yeah,
is.
there was a problem with that too, though. Obviously.
I don't know if you know what happened
Sure.
right after that.
No,
but-
I took. Well, no. This was like crony, bad, just been
The
bad lending
ninja
practice,
loans, no
but
income, no job.
forced upon the banks or encouraged by the federal government, right? Remember, Acorn was out there, like everyone needs to own a home, and encouraging subprime mortgages. Like it was, Anyway,
Government intervention strikes again.
no question. Hey, we have a good question here.
Yeah.
And Dave Waller already answered it very concisely. So it says, I'm understanding that IBC is good with mutual owned insurance companies, but there is a lot of media that you can use IUL to do the same, but faster.
Now, I think it's important to define what is the same. To do, what does that mean? To do the same.
Right. What do you mean? Do we mean practice IBC? Is that what we're talking about?
Can you guys hear me?
Yeah,
Yeah.
we can hear you.
All right, perfect. No, I really want to, from our last conversation as well, really want to practice IBC and fully have the life insurance all set up so I can actually do instant banking, not rely on the banks. That $2,500 deposit and they question you like a million times. I've had that happen so many times already. It is so annoying and so frustrating. So right now, I just got my agent license, and I'm trying to figure out how do you figure out which insurance companies to pick and to do this with, because it's like you hear all this different media saying that, hey, and by same and better, what I mean is that they said that with IULs, you fill up your I can't remember the terms right now, but basically you gain more value from an IUL account than you would.
Yeah, you'll have more cash value with the same premium, or it'll grow faster,
Yeah, exactly.
or you'll get better
Exactly.
rates of return. They like to talk rates of return a lot.
Yes.
Yeah.
Which I know in this case for IBC, we don't. I'm not really supposed to be concerned about that because we want to think about, hey, this is our company, we're putting into it, right? We're going to get dividends from our company, and this is more, I guess, reliable, more stable, and mutually owned, right? We have a piece of the pie. Whereas in IUL, you're not like that. It's just a company you pay, but now they have, you never lose anything. They have the floor, and of course they also have the max of how much you can maximum make. And they said that always outpaces any regular, like let's say the whole mutual whole life insurance companies.
Yeah.
Right.
So they have the floor on the losses year to year. What they're lacking is a ceiling on the premium. So, and I've seen lots of IUL policies, and frankly, I've seen some that, hey, in the time that this person owned it, it performed very well. Like they got a lot more cash value than they paid in premium. But they also see the writing on the wall because, You can do the same thing, but faster. Well, do you want to get there fast or do you want to get there? It depends on what you're trying to do faster. Is this just an arbitration play? Are you just trying to get as much as you can and go use it somewhere else? Or do you want something that's actually going to last? So
Yeah, I think fast in my perspective is specifically for me. I'm in my 40s already, so I'm starting this late. Fast for me would be I want to catch up to what I missed out for the last 20 years, or my whole life, I guess, and try to catch up as quick as possible to the point where I should be if I had just done this from the beginning of time, right? The regular basic way.
Yeah, so I just got done talking about how people are glued to the TV because of the stock market. I don't think having an insurance product that is, more or less directly correlated to some sort of indice that is banking on the performance of something that you don't have control over. It's not Nelson. I'll simplify it this way. Nelson had very little to say about IUL except it's not appropriate for the use of IBC, and that is good enough for every single one of us, and we should move along. Dave and I have never sold one of those policies, and I'm kind of paraphrasing Nelson here, nor would we ever own one. And I think that's enough to know because they just, early on, if you're young, they can look okay. But as time goes by, if you're not interested in leaving a legacy, I actually had a conversation with an IUL guy about this. He's like, well, it's not for that. That was a direct quote from him. It's not for leaving a legacy.
Which is interesting because it's life insurance.
Right.
Right?
So.
But it wasn't built for life insurance.
No. I don't want to. I don't know if I could say this, but I won't participate in any IUL thing.
No, the biggest thing, TC, is risk. A lot of the risk lies with the policyholder in IUL.
Right.
With whole life insurance, all the risk has been transferred to the company.
Right. Which is the purpose.
Yeah, that's the purpose of insurance, period.
And there are, to quote, I think Todd Langford maybe, but there are no deals in insurance. Right. You're giving up something. Dave just said what you're giving up. You're giving up guarantees in favor of risk to get maybe and we've heard what's his face on the podcast, the author of that book, talking about you might get an extra point. Right?
Yeah.
That's what he
said.
That's it?
Yeah. I don't know.
So if I can if my internal rate of return on my whole life policy is 3 and this IUL might be 4, but with no guarantee of that, it could be, bottom line, eventually it's likely going to blow up, the policies. They're going to blow up as you get older.
Yeah. There's no guarantee it'll be there when you die. If you live beyond, sometimes even age 65, there's no guarantee.
Right. So,
so that answers my question as far as I do want to practice the IBC concept. That's the reason why I follow and listen to you guys as well as other podcasts. But then now the question is, being an agent right now, how do I know which insurance companies are the ones that I would if I'm going to sell someone insurance, even myself, purchase one? How do I know which ones are the ones that's going to be actually confined to that whole IBC concept, right? The mutually owned, companies.
Tell you what, just shoot us an email to our wealth warehouse email, and I'll respond to you.
But in general, a mutual company that's been around and been paying dividends for over 100 years and has a good Comdex score. So you can search, that's public information. You can search Comdex ratings and, in the 90s, let's say.
Yes.
Comdex in the 90s is what I would recommend.
Yep. And I would say beyond that, as you dig a little bit deeper, you need to look at the terms of like their paid up additions riders. Some of them are kind of inflexible, like kind of stiff and rigid, where, we want our clients to have maximum flexibility. So we choose to write business for companies that have more flex in their PUA rider. That's very important for this.
And I'd say there's more good companies out there than there are good companies that are suitable for IBC. Because not every good mutual life insurance company is going to be a good one for the infinite banking concept.
Right.
Yeah. But yeah, go ahead and
That's very
email us.
helpful. Thank you, guys.
Yeah, you
Yeah,
bet.
you bet.
I will. I'll find your email you guys.
Yep, it's in the show note links.
Thank you so
Well,
much.
all right. Yeah.
You're welcome.
Well,
Hi.
we hit.
Hi.
Yeah, go ahead.
Again, usually, or what does Nelson Nash say is a good split for policy? Is it 40-60? Because I'm hearing a lot about 1090. There's someone in particular on YouTube that's really pushing that pretty heavily. I don't know
yeah.
if it's just for businesses or is it for individuals as well? But what would you recommend to your client? Is it based on what their needs are? Could you kind of address that, please?
Yeah. Well, one, Nelson doesn't say anything about it.
Right.
And in general, the Nelson Nash Institute doesn't take a position one way or another, other than it's pretty unanimous amongst IBC practitioners. The 1090, where 10% base, 90% PUA, is not a good design for the long term. And it's not something we promote, or frankly, I've never written one like that.
Same.
Yeah. So you want a solid enough base it's like the foundation of your bank. You want a solid foundation. The base, I'd say, becomes more important the longer the policy goes and grows, because that's going to be the most productive piece of it. That's the biggest part of that engine is the base premium. It's doing the most work for you long term.
Was that Amani again?
Yeah.
Oh, yeah. Yeah, Amani, I just opened up a policy on myself back in January that's 70% base.
Wow. Okay. Is that something you would recommend if a person is looking at this long term and they say 20 years from now, I want to retire? So would you put more money towards the base then?
No, not necessarily. That's just what worked for me because I have a bunch of mature policies that are fairly old now. We would look at your a person's circumstances individually and design a policy that would be more appropriate for somebody at whatever, based on their goals, a 20-year plan, whatever their current age. That's how we would design the policy. So your policies aren't going to look like mine. They're not mine. Maybe don't look like Dave's, or they're probably fairly close. Don't look like somebody else's. So it's all individually based. So we would custom design it for your needs.
Okay.
Yeah.
Thank you.
Yep.
You bet.
And Tyler mentions, he comments, isn't your dividend calculated off of your base? Probably in the policy you have, Tyler. Yeah, that, each product is different, but the products we like are the ones that the dividend is really heavily weighted towards the base.
Yeah.
Yeah.
Yes. Yeah. You have Tyler, your policies are participating, so they're they're receiving dividends if you look at your annual statements, everybody, off the base and the PUA premium. But if you look at the difference in the dividend credited, the base dividend is many times larger than the PUA dividend.
Yeah, which makes a big difference down the road. If you're thinking with a long range view, think long range.
Right.
Yeah. All right. Well, good questions. It's been an hour, so we'll cut it off here unless anybody's got any final questions or comments. All right. Well, keep the comments coming. Keep the questions coming.
David,
Yeah,
I got
Barry,
a question.
go
Yeah,
for
I
it.
was looking at you talk about that note, whatever, what you're doing. Just I'm still been looking into that. I've just been scared to learn. I mean, not scared, but trying to learn how to do a note
Yeah.
on that. To write it up if something would ever happen. I mean, that's for lending money too. I know. I think you guys do that. Just be interesting how to learn how to do that, how to set it up if something would happen. How do you get your money back and all that stuff.
Yeah. Well, shoot me an email. Let's set up some time. You got my scheduling link. But the
Okay.
good news is you don't have to learn how to do this from scratch.
Okay.
The system's already set up, and it's just, how much do you want to participate with? Here's the terms.
Yeah. Okay.
And a proven model. And, that's what I like to do with some of my cash value loans. You know, I don't ever advise anybody on what to do when it comes to the investment arena, but I'm happy to show you what I'm doing and what options are available, and then you make your own decision.
Okay. Sounds good then.
Yeah. Set up some time, buddy.
Dave, one last
Sounds good.
question. Your
Yeah.
script where you do the IBC and you're drawing it out, is that trademark?
No, I haven't trademarked anything.
Oh, okay.
It's I had a lot of free time during COVID, let's say, like all of us did. So thought I'd put it to good use, but nope, not trademarked. If you want to post that YouTube link anywhere, feel free.
Oh, thank you. It explains IBC so simply and quickly, and it's really understandable.
Thank you. That was the whole point that I was going for.
Okay, well, you definitely hit it right on the nail, on the head. Thank
Good.
you.
Good. Hey, if I can do anything, it's make things easier for a simple mind to understand. I've been having to do that my whole life for myself. So there you go. All right. Well, hey, thanks for joining, everybody. And look forward to next month. Hopefully everybody's getting some summer weather right now. Kate's all bundled up. So is David. So obviously you guys are not enjoying the summer weather.
It had been really warm, but it's dipped down into the 30s and 40s and snowing again here in Wyoming.
Ooh,
So
wow.
until next weekend, we'll be back in the 70s again next weekend, just in time for Memorial Day. So, you know,
Sweet.
life in the extremes.
Yeah. Enjoy. All right. Well, good to see you guys. And until next time, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle in a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.